Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tshepho Modiba, and thanks for joining me. Tonight, I'm joined by Tim Nhamo, Director at Global Financial Innovations. Tim, thanks for joining us again.
It was good to see you again.
Get to speak about certainly bond yields around the continent. It's generally been a positive environment for emerging markets, specifically on the fixed income side. Has that trend continued for the continent?
Yes, since I was on about 2 months ago, pretty much what we've seen is more of the same. So you've got a weaker dollar, generally speaking.
Right.
We haven't seen very strong inflows into the US, so obviously funds rather than a flight to safety, for example, in the US. Instead, global investors and emerging market managers are looking to push money into other parts of the world, including emerging markets, and then from there you then look at how much of that emerging market flow comes to Africa.
Before we get into the details of it, is that really is that global investors seeing emerging markets as a little bit more of a safe haven, or is it driven more by what we've spoken about for a few years now, this hunt for yield?
It's the hunt for yield, but obviously that hunt for yield is driven by alternatives.
Right.
So in our instance, for example, at the beginning of the year, some people were expecting 3 rate hikes from the US, and those rate hikes haven't come through. So then obviously people are then looking for other places to put money. The UK is a bit of a 50-50 because of the runoff from the second round effect from Brexit.
Right.
Europe has its own structural issues, which then leaves you to look at the rest of the world, be it Southeast Asia or Africa or Latin America and so on.
Right. What have we seen from a currency perspective on the continent? Certainly the last few years we've seen massive amounts of volatility. Has volatility been the theme again this year or not?
The volatility is there somewhat, but more in West Africa than East Africa. So East Africa has been very stable, especially your Kenya and Uganda. So Kenya recently had an election that went off quite well. Uganda, the Ugandan shilling is quite stable. It may weaken slightly, but nothing dramatic. And then Tanzania has also been quite stable. On the West African side, one of the market that we look at the most is Nigeria. Obviously, they've had basically your balance of payment issues and shortages of US dollars, which is consistently putting pressure on the exchange rate. And that tends to take the shine, or from a foreign investor perspective, that tends to take the shine off whether you're looking at equities or the fixed income space.
Okay, let's focus our attention. So I guess the trend has been narrowing yields, stable to improving currencies broadly across the continent. What looks attractive from a fixed income perspective? Let's start in East Africa. What does East Africa look like right now?
Okay, so East Africa, you've how can I put it? The spread, or the call it excess yield or whatever, is falling away. Obviously, because there's been a lot of buying in. So if you look at a country like Kenya, we have a preference for the infrastructure bond, the 2031 maturity, simply because there's no withholding tax. Everything else you're going to have non-infrastructure bond. There's a tax implication which reduces your yield.
Right.
Currency, there's not much of a play there, so there'll be a lot of buying of paper across the curve, which then reduces yield opportunities.
So specifically, within Kenya, some of the easy money is gone, and you really have to be a little bit more nimble in terms of which sectors you're picking there.
Yeah, so that's certainly the case with Kenya. More so even with Uganda, where now Uganda again, the rate might weaken against the US dollar. The US dollar might appreciate a little bit. Nothing overly to be concerned about. However, you don't really have an NDF play in there, so you'd actually have to liquidate dollars, go into the local, find something in on the local side, and then come back.
Okay, let's just unpack that NDF. What are we talking about there?
It's basically an undeliverable forward, which is a hedging instrument.
Right.
So normally what you do, if you're looking to get into a country, if you're doing the physical cash flow, you obviously take your US dollars, you sell them, you invest in whatever you're investing, be it fixed income, equity, etc. And then on the back end, you come out of it on the spot leg. So you hedge it using a forward. And then the offshores tend to use non-deliverable forwards because they're made by offshore banks and so on.
Okay. The rest of East Africa?
The rest of East Africa, again, Tanzania. If you are able, normally you'd have to structure Tanzania through Kenya if you can. Get a Kenyan bank to put something together for you. The one that's quite interesting, for example, is Mozambique. So now Mozambique, not quite East Africa, but we're coming down the coast.
Way south.
Yeah, way south. There, the appreciation of the currency had sort of caught people by surprise.
Okay.
Now IMF and your macroeconomic issues are now coming back into play. So we're starting to see a bit of weakness coming through on the currency. So not too much going on there.
So Mozambique is something that makes you a little bit nervous right now, given the currency aspect of
the currency aspect and the IMF balance of payment support issues now make Mozambique a slightly harder play.
Okay.
And then if we go across to Zambia, there's not a lot going on. Yields have come down, currency's flat. There's not much of a gap to take advantage of there.
Right.
And then if we move across Angola, MPLA won the election again. Not by as much of a majority as they had the last time. We're expecting a devaluation probably somewhere 4 to 6 months out. So that's quite an attractive play if you sort of want to trade, well, if you're looking for currency weakness, sort of going out in the 9 to 12 month region.
Just, I guess, taking a moment there, how do you, on the fixed income space, how do you take advantage of the geopolitical landscape or elections that we've seen across the continent? Do you almost have to have a specific view around the outcome of the elections, or how do you play that really in a fixed income portfolio?
The main issue with the elections, I guess, is just regarding government maneuvering. I mean, you don't see it in, for example, more developed countries. But for example, normally throughout Africa, in the run-up to an election, there's usually, for example, say a lot of money printing and so on, which can affect the dynamics. And then also, if there's going to be any instability, for example, around.
And money printing for the purposes of what, trying to boost short-term economy?
Yeah, just lose fiscal policy to just to pump things up a little bit.
Right.
And get the electorate.
So in the lead up to elections, you're likely to see a spike in inflation, as an example?
Inflation, not so much, usually more money supply and spending, which then affects more your, say, budget deficit type numbers.
Gotcha.
More than an inflation number, because also inflation to an extent can be massaged in terms of the way it's measured.
Right. So it's not necessarily taking a particular view on the outcome, but really looking at the fundamentals of what's going on the ground.
Yeah.
Okay. Let's spend a little bit of time on West Africa. What does the landscape look like? You touched a little bit on Nigeria. Being one of the largest economies on the continent, what does Nigeria look like from a fixed income perspective? So
one of the issues now with fixed income in Nigeria, depending on what sort of size you're wanting to do a transaction, I mean, if you're a small guy moving 500,000, you can probably move it in and move it out. But if you're a bigger fund with, I don't know, trying to do $50 million, it's a little bit of a problem. So because of that, we would say that if you are a larger player, there's not a lot going on in Nigeria. However, there is quite a big gap between the local yields available and what it costs to hedge out the currency risk. And in the 12-month, the gap is about 10%. So just looking at it, you're in the 1 year, you've got a 22 yield against an 11% hedge, for example. So that's a 10% gap. Right. But you've also got to be able to get your US dollars out at the end of it.
So potentially not worth it.
A lot of it is about size. Your overriding factor, less than the numbers, is how much volume you can actually put through comfortably. Okay.
Anywhere else in West Africa that looks attractive? It sounds overridingly like a lot of what was attractive 2 months ago when we met. A lot of those returns have filtered through, and it's becoming a little bit more nuanced in terms of making easy money on the continent as a whole.
The nuance factor is pretty much increasing across the board as you're seeing people coming in and taking advantage of a lot of the gaps that have been there. So going forward, it's still a little bit early, but I'd say as time passes. So, for example, going into Christmas, Nigeria, the currency weakening is going to outperform or exceed anything that you will get on the yield side.
Gotcha.
But then going into next year, we're expecting things to stabilize. So, you might want to later on in the year start looking more and more at taking on local exposure in the Nigerian side of things.
Understood. Anywhere else, West Africa, that looks interesting?
Ghana's pretty even. I mean, when you look at currency expectations versus interest rates, there's again that it's as you said, that's more a nuanced play, and that's where you have to start looking at things like, well, am I going to take local exposure but not match the hedge straight away, and carry some exchange rate risk?
Okay, let's spend a bit of time on a market that you actually do like in terms of a yield perspective. You spoke a little bit about Egypt. What's the outlook there from a fixed income perspective?
So I'd say Egypt is pretty much the opportunity that stands out the most. So there you're looking at about a 19 yield again against a 12% hedge, or you don't even have to hedge yourself. So for example, if you, one of the things we'd noticed was that the central bank has reduced the exchange rate that they use for customs purposes and calculation of import duties.
How does that impact the outlook?
It doesn't necessarily impact the output. We just sort of looked at it and wondered if, or openly or speculating, is this a signal that, so for example, if you're the central bank and you say you publish the rate monthly or whatever it is,
right,
you'd be less likely to reduce your US dollar Egyptian pound rate if you felt that there was risk going forward.
Gotcha.
So the way we're interpreting it is that because that rate has been reduced slightly, we're interpreting that at the very least the central bank is expecting the exchange rate to be stable, if not stronger going forward.
Okay.
Right, and in that sort of scenario, sort of selling US dollars, buying Egyptian paper like the 1 year is at 19 becomes a very attractive proposition. And then also with expected IMF inflows, there's less likely to for there to be a liquidity problem a year out.
Right.
So I'd say the standout play from our perspective at the moment would be doing something around Egypt.
So taking advantage of those stable currency, 19% yields, that sounds like a decent recipe for making good returns.
Yeah.
Okay, perfect. Thanks to my guest, Tim Nhamo, Director at Global Financial Innovations. That's all from Buy Africa this week. Remember to follow me on Twitter, that's at Modiba_Tshepho, and also follow Tim at absolute_alpha. Send us your thoughts about the show using the hashtag BuyAfrica. For myself and the team,